All right. Hello. Hello. Hello.
Hi.
All right. Okay. Can you all see the screen? Can you see the screen?
No.
There's no showing. Okay. All right. Can you see the screen now? Do you see the screen now? Hello.
Yes.
Okay. Good. All right. So we are starting. Good evening once again. Good evening, class. So uh, today we are going to have a short intervention class. Excuse me, just a minute. All right, I'm back. So today we are going to do a short intervention class on financial reporting. We are going to focus on IFRS standards. IFRS standards form a significant part of the examination. So mastering it is something that you cannot do away with. All right. So I mean, once you are able to master the IFRS standards, it will really boost your chances of passing the FR examination. We know that the FR examination, I mean, comes with a section structure. We have consolidation, and then we have consolidation. We have what else do we have? We have standards. What else do we have? Hello, are we there? Michael.
Yes, we are here.
All right, so consolidation standards. What else?
Analysis. Ratios analysis.
Yeah, analysis. Yeah, interpretation of financial ratios. And then what else?
Conceptual ethics.
We have ethics. And we also have published accounts. You know, and consolidation and published accounts are usually quite challenging, and it also takes a lot of time. So it's not something that you can really bank on. Okay, but for topics like the standards and let's say interpretation of financial statements and ethics, if you try and get some good marks there, it will really help you. and after that you come and try your best on the consolidation and on the publish account. And usually the standards are straightforward. So if you know the principles, then I mean you are good to go. Okay. So the standards are very necessary. Alright. So that's why I want us to look at some of the key standards today. Alright. So without wasting my time, let's get started. Alright. So today we are going to look at a number of standards. Not a number, just some few standards. We are going to look at IFRS 16, what else? IAS 20, and then what else? IFRS 5. Okay, let's deal with these three first. Then, if there is time, we will look at the rest. Okay, so we are going to start with IFRS 16. Okay, IFRS 16 is about what? Leases. Is that not so? It's about leases. So, what do you know about IFRS 16? Anyone to share ideas? What do you know about IFRS 16? This is revision class, so I guess by now we've already gone through the standard. Anyone to give us something on IFRS 16? Anyone to try? Michael, are you there?
Max, I'm on call. I'm coming, please.
Are you on the call? Okay. IFRS 16. Who can tell us something about it? Okay, what is a lease? What is a lease? IFRS 16 is about accounting treatment of leases, how to account for leases. So what is a lease? You need to know what a lease is, and then from there we'll be able to know how to go about it.
Okay, it's like you buy using an asset which you didn't buy, but you are using it and accounting as if it is your own.
Okay, all right, correct. Yeah, so a lease is basically, let me say, using an asset which does not belong to you, but then you pay for it. So a typical example is renting an apartment or renting an office complex, office building. So a lease is usually a contract. It's between the owner of the property and then let me say the user or whoever is coming to use the property. Okay, and in the contract, the owner or the user will pay, okay, for the right to use the assets, and it's for a period of time. So it could be 1 year, it could be 2 years, it could be 3 years. Okay, so that's basically what lease is, and it's like the normal rent we know. Okay, normal rentals we know. So there are two main parties. Okay, we have the owner of the property, uh, and then we have let me say, the user. So the owner is called the lessor. Okay, the owner of the property is called the lessor, and then the user is called the lessee. Do you get it? The owner is called the lessor, and then the user is called the lessee. So the user will pay the owner, okay, and the owner will give the user the access or the right to use the property for a period of time. Do you get it? So that's basically what lease is. All right. So there are two types of leases. We have finance lease and operating lease. We have finance lease and then operating lease. You know. So what is finance lease? Finance lease is when um, the user leases an asset for a long time, or maybe for the useful life of the asset. Maybe we have an asset here, and the useful life of this asset is maybe 10 years. But the receipt or the user is going to use the asset for maybe for the whole 10 years. Okay. So this becomes a finance lease. Okay, so a finance lease is a form of lease where the user is going to use the assets over or almost for the useful life of the assets. Okay, so it's usually for extended period of time, or the lease covers the entire or almost the entire useful life of the asset. Okay, and finance lease is a way of acquiring an asset without buying it outright. Okay, so let's say you want to buy a car, but you don't have the means now. So you enter into an agreement that okay, every year you pay maybe 20,000. You pay 20,000 for 5 years. So that at the end of the 5 years, the car will become yours. Do you get? At the end of 5 years, the car becomes yours. So it's a finance arrangement, just that you are paying it in installments. Do you get? But operating lease, on the other hand, is a lease um, that is usually for a short period of time, and at the end of the lease, there's no transfer of ownership. Under finance lease, usually at the end of the lease, the the assets will be transferred to the lessee. Okay, because at the end of the lease, the lessee would have paid for the full, let me say, cost of the assets. Okay, so like an example, the car example I gave, you enter into an agreement to buy a car, and because you don't have enough money, you pay it in installments for 5 years, and after 5 years, it becomes yours. Okay, so after 5 years, the ownership is transferred to the lessee. All right, so that is a finance lease. All right, so these are the two types of leases: finance lease and operating lease. Yeah. So when it comes to lease, there are two key things you need to know. Okay, they are lease liability. I'm sure you've heard of this lease liability, and then we also have rights of use. Rights of use assets. Okay, so what is a lease liability? Anyone to try? We are doing revision, so I'm sure by now you would have already gone over this. Anyone to explain what a lease liability is? All right, so a lease liability. Let me give an illustration. So let's say we have um, a lessee, okay, and we have a lessor. The lessor is the owner, or let's say the landlord, and this is the tenant or the user. Okay, so the lessee has entered into an arrangement with the lessor to use, let's say, a building for 5 years. All right, and every year, the lessee is going to pay maybe 5,000 cedis for 5 years. Okay, the lessee is going to pay 5,000 cedis for annually for 5 years. So at the end of the lease, how much would the lessee have paid? How much do you think the lessee would have paid at the end of the lease? That would be 5,000 times 5, right? That would be 25,000. Is that also 1, 2, 3, 4, 5? Yeah, so at the end of the lease, the lessor would have paid 25,000. Okay, alright. So this 25,000 is what we call the lease liability. Okay, so lease liability refers to the part of the, let me see, the part of the lease payment which has not been settled. Okay, is the lease payment which has not been settled. Do you get it? But another thing you have to remember is that all these payments are going to be made in the future, assuming that we are starting the lease at year zero. Alright, all these payments are going to be made at in the future. So at the beginning of the lease or at the commencement of the lease, we need to find the present values of all these payments. Alright, so a lease liability is defined as the present values of future lease payments. Okay? So the correct definition of lease liability is what? The present value of is the present value of what? Future lease payments. Do you get it? Future lease payments. Alright, so that's the lease liability. Alright, so we have defined the lease liability. The next thing we have to define is right of use.
Good evening. Good evening.
It's coming from Dominic.
Yeah, Dominic. Alright. Okay, let's continue. So lease liability refers to present value of future lease payments. And the right of use is it's an asset. Right of use, this is an asset. Okay. This is the right to use the asset for a period of time. Okay. You have paid the landlord. And the landlord has given you rights. So that right is a form of asset. Okay. So the lease liability and the right of use, they go together. You pay for something and you are given the right to use that asset. Okay. So the right of use is the same as the right of use is the right to use an asset, okay, the lease asset. Okay, and it is equal to the lease liability. Okay, right of use is equal to the lease liability. It's equal to the lease liability plus any direct cost associated with the lease. Okay, if there's any cost you incurred in arranging for the lease, for instance, if you want to rent an apartment, usually, going searching for it yourself is sometimes challenging. So you may need an agent, the services of an agent to help you, and you have to pay agent fees and viewing fees and those things. So all those costs fall under direct costs. Immediately. So the right of use is equal to the lease liability plus all direct costs you incurred in arranging the lease. Do you get it? Any questions so far? So when it comes to lease, these two things are the main things you need to know: lease liability and right of use. And you need to know how to calculate lease liability and also how to calculate right of use. Do you get it? All right. So with this explanation, let's test our understanding. See whether we understand what we have learned. Okay, so we have a question here. Question one. Odria Limited operates in the mining industry with a financial year end 31st December 2020. On 1st January 2020, Odria Limited began to lease a group of machines that were used in the production process. The lease was for 5 years, and the total annual rentals payable in arrears was 8 million. The lessor paid 30 million for the machines on 31st December 2019. The lessor has advised Odria that the interest rates implicit in the lease can be taken as 10%. The estimated useful economic life of the machine were 5 years. Required in accordance with IFRS 16, leases show the accounting treatment of the above transaction. Alright, so let's see how we go about it. So when it comes to lease, we are looking for our lease liability and then our right of use. Okay, these are the two terms we need to look out for. Alright, what is lease liability? Lease liability is the present value of the future lease payments. And another thing you need to notice whether the lease payment is in advance or in arrears. Okay, there are two ways, or there are two lease payment types of lease payment, either in advance or in arrears. Okay, so here we are told that this is in arrears. It means we pay at the end of the lease or at the end of using the every year we'll pay at the end of the year. Advance means you pay before you use the asset. Arrears means you use the asset before you pay. Do you get it? So let's find our lease liability. The lease liability is equal to the present value of all the future lease payments. So the commencement of the lease was on 1st January 2020. Okay, so we know the commencement date. Commencement date is what? 1st January 2020. Alright, so we need to know the lease liability on this date. Okay, and then the right of use assets on this date. Okay, now the lease liability, like I explained, is the present value of future lease payment, or it is the fair value of the assets. Okay, so there are it has two values, either the present value of the lease payment or is the fair value of the leased asset. So any of them will do. So in exams, if they give you the fair value of the assets, you are good to go. But if they don't give you, it means you have to calculate the present value of you have to calculate the present value of all the lease liabilities. Do you get it? So in this question, we have to check whether we were given the fair value. So what do you think? Were we given the fair value or not? Or we're only given what were we given? What do you think? So from the question, they gave us the payments. Okay, the lease was for 5 years and total annual rental was 8 million. So it means every year Odrell Limited is going to pay 8 million for the lease, for 5 years. Okay. And then this information, the lessor paid 30 million for the machine on 31st December 2019. This statement is talking about the fair value of the machine. This statement, 30 million, is talking about the fair value of the machine. So once you see this, you can take it as the lease liability, which is 30 million. Or you can decide to calculate it here if you want to confirm whether the 30 million is actually the lease liability. You can find the present value of all the lease payments, okay, and you will still get the 30 million. So we can do an example here. So let me, okay, so the lease is for 5 years, so 5 years, and every year we are paying 8 million. So let me say eight, eight, eight. So this is in millions, okay. So what is the discount factor? Okay, so from the question, the discount factor is 10%. Okay, so then we find the present value. So there's the present value. So for year one, the discount factor is going to be 1 over 1 plus 10% raised the power 1.
0.09901909.
Yeah, so that's year one. So this is year two, this is year three, this is year four. Okay, so we have our discount factors, so we can calculate our present values. We multiply the payment by the discount factor to get your present value. When you finish, you add all your present values. So you can see we are getting the 30 million, right? Which is the same as what the same as, or it's almost the same as this. So in exams, you don't need to, if you are given the fair value straightforward, you don't need to do these workings. Okay, it's going to take your time. It's only when you are not given this, that is when you have to go by this. Right, so you have to know this. Yeah, so we know our lease liability, which is 30 million. So our lease liability is equal to 30 million. Now we have to find our right of use. Our right of use is equal to the lease liability plus any direct cost. So when you look at this, is there any direct cost here? There's no direct cost. So it means that our right of use is also equal to 30 million cedis. Okay, so we are done. We are done with the initial recognition. Now let's go to the recognition at the end of the year. At the end of the year, okay. At the end of the year, 31st December 2020. So remember that at the end of the year, Odra is going to make first payment. You're going to make first payment. Do you get it? And it will reduce the payment will reduce the lease liability. Do you get it? So we have what we call a lease schedule. Okay? That lease schedule is what we use to determine the lease liability balance at the end of each year. Okay? So this is how we go about the lease schedule. So the lease schedule, we start with the year and then the lease liability. Then interest. Then payment. Then we have the closing liability. So that's how we construct the lease schedule. Okay. So we are looking at 31st December 2020. So at the beginning of the year, the lease liability was how much? 30 million. We put it here. The interest is 10%. So 10% of 30 million will give you how much? So 10% times 30 give you 3. Payments. How much did we pay in the year? 8. What's the closing liability? The closing is the lease liability plus interest minus payments, which is 30 plus 3 minus 8. Will give you 25. So at the end of the year, this is our lease liability. This is our closing lease liability. Do you get it? But then we have to break this liability into two. We have to break it into current liability and we have to break it into current liability and non-current liability. We have to break it to current liability and non-current liability. Okay. Current liability is the part of the lease is the part of the lease liability we will pay the following year. Because we are not going to pay all this amount just next year. We will pay some the following year. That is, we pay some 31st December 2021. And we will leave some. We are not going to pay everything the following year. So the current liability is the one we are going to pay next year. The non-current is the one that will be the amount that will be left after paying for the next year. So to get the current and the non-current, we need to go to the next line or next year and do the schedule again. So we bring this 25 will come here and we calculate 10% on the 25. Which will give us 2.5. Then we'll still pay 8 and then our closing liability is going to be 25 plus 2.5 minus 8. That's 19.5. Alright. So at the end of year, this is year 1, this is year 2. At the end of year two, this is the non-current, this is the liability or the lease liability we have to pay. Okay, so this figure becomes our non-current liability. Okay, and the difference between this and this is our current liability. Our current liability is what 5.5. Okay, our current liability is the 19.5 minus 25. 25 minus 19.5. Alright, that's it. That's our current liability. Another way of determining the current liability is the current liability is the difference between the payment and the interest. The payment and the interest. So it's the same as 8 minus 2.5, which will give you 5.5. Do you get it? So that is another way of determining the current liability. So we are done with the current and the non-current. Okay, so we are done with the list. So in our balance sheets, okay, let's go to the right of use. So we are done with the liability. Let's go to the right of use. Now the right of use is an asset. So and it's going to be depreciated, and it's going to be depreciated over the useful life of the or over the lease period. Okay, so we know that our right of use is 30 million. Okay, and then the lease is for 5 years. The lease term is 5 years. Okay, so we are going to depreciate this over 5 years. Okay, so depreciation is going to be 30 over 5 to give you 6. Okay, so the carrying amount of our right of use is going to be 30 minus 6 to give you 24. That is how it will look like. Okay, so this is how the presentation will look like. This is how the presentation will look like. So in the balance sheet, okay, under your assets, non-current assets, okay, you recognize right of use. How much? 24. 24 million. Then that is the asset part. We come to liabilities. And the liabilities, you break it into two. Non-current liability. Non-current liability is going to be 19.5. And then the current liability is going to be 5.5. Okay, so that is it. So this is how the balance sheet will look like. Let's come to the income statement, the profit or loss. The profit or loss, we are going to recognize finance cost or finance cost of how much? This one, 3 million. So this is an expense. Then we also recognize depreciation. Depreciation of the lease assets. This one. Where is it? Depreciation of 6 million. Alright, so that's how the presentation is going to look like. It's very straightforward. So that's how we go about lease. You can see it's not difficult. So when it comes You should be able to do it. All right, any question? All right, if there's no question, let's go to the next standard, IAS 20. Okay, this is about government grants. Mm. All right, so what is government grants? A grant is a financial, let me say, a financial incentive or a reward that the government gives to institutions or organizations, okay, to for the purpose or for a particular purpose or to accomplish a particular objective. Okay, and grant is one of the ways the government um, use to develop certain sectors of the economy. If the government wants to develop the agricultural sector, it will try and give grant to agricultural businesses to at least help them. Alright, so grant is a form of financial support that entities receive from various government agencies. Alright, so as accountants, we need to know how to recognize government grants in our financial statement. But then you need to know the types of grants. There are two main types. There are grants that the government gives to for the purpose of purchasing non-current assets. Okay, so government gives grants for the company to buy a new vehicle, to buy equipment, to maybe buy machines, plants, or whatever it is. Those are called capital grants. And then we also have grants that are for other purposes. Okay, those grants are called revenue grants. Okay. Any grant that is for any other purpose apart from purchasing of non-current assets is called revenue grants. Do you get it? Now, we need to, as accountants, usually before you recognize, we have to be careful when we are recognizing items in our financial statements. Okay, we don't wake up and recognize anything like that. Okay, so the same applies to government grants. So before you recognize government grants, certain conditions must be met. And usually, grants comes with certain directives. Okay, so the government will give you grants that, oh, use this money to buy this, use this money for this purpose, use this money for this. Okay, so grant comes with its own directives. Okay, so one 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 condition that must be met before you can recognize a grant is that the company should be or the company should have reasonable assurance that they will fulfill the conditions attached to the grant. Okay, they will do whatever is in the or whatever comes with the grant, whatever responsibility comes with the grant, the company will fulfill it. Okay. Another condition is that the company should have reasonable assurance that the grant will be received. Governments sometimes they can give out promises or will give businesses this amount, this and that. They are just sometimes they are political, uh, just for political talk. They are just political talks. Okay, so you cannot dwell on political talk to recognize grants. Before you recognize grants, there must be a reasonable assurance that you are going to receive the grant, not just political talk that the government is saying. Okay, so two conditions must be met. One is that you are going to fulfill the conditions attached to the grant, and two, there's a reasonable assurance that they are going to receive the grant. Okay, so when these two conditions are met, you can recognize the grant. Alright. So let's look at the, recognition of capital grants, and then we'll also look at recognition of revenue grants. So capital grant is for purchasing of non-current assets. So let's say that company company A wants to buy an asset, and the cost of the asset is 500,000. Okay. This asset has a useful life. This asset has a useful life of 5 years. Okay, the asset is going to be used for 5 years, and the government has given a grant of maybe 200,000. The government has given a grant of 200,000 to buy this machine or this asset. Alright, so it means that the company is just going to add 300,000 to it. And then also the government is going to pay 300,000, and then the government will also support with 200,000. So government has paid the money. Okay, government has paid the money, and they have gone to um, buy the assets. So let's say let's look at the initial receipts of the grants. Okay, the government has paid the money, right? So they are going to debit their bank. The company is going to debit the bank of 200,000. That means so 200,000. Then they are going to recognize grants of 200,000. Okay, this is going to be treated as deferred income. Okay, okay. It will be part of let me say reserves. Okay, the company can treat it as reserve under equity, or called deferred income. Okay, now the company has gone to buy the assets. So buying the assets, what is the double entry? Okay, so the asset has come. So we debit the asset. Maybe it's a machine. Debit it with 200,000. Then we'll credit bank because they use money to buy it. 200,000, like that. So this is the initial receipt of the money. Okay, and this is the purchase of the assets. Do you get it? Right. Now let's look at the subsequent treatment. This is the initial recognition. So at the end of the year, what entries are we supposed to make? Now that's what we are going to look at. Okay, subsequent treatment. Now, when it comes to subsequent treatment, there are two ways of going about it. Okay, there are two ways of going about it. Okay, one, we'll look at the first way, and then we'll look at the second way. All right, so now we have received the grant. It's in our in our balance sheet. Okay, in our balance sheet, we bought the machine and our assets, and it's now asset. We have the machine. Okay, the machine that we bought is 500,000. Under our liabilities or under our equity, let me say it's the equity. We have deferred income, which represents the grants, 200,000. Okay, okay. This grant goes with this. Now remember that this machine is going to be depreciated. Okay, it's going to be depreciated over 5 years. So it also means that this amount also will be amortized over what? 5 years. Do you get it? This machine is going to depreciate over 5 years. This will also be amortized over, so that at the end of the 5 years, this place will be nil. This will also be nil. Okay, it means that the grants have been exhausted. Do you get it? So we are at the end of year one, right? So at the end of year one, we have to depreciate the machine. Okay, so we know the cost of the machine is 500,000, and then depreciation. It's the useful life is 5 years. So 500,000 over 5. So how much are we going to get? 100,000. So the current amount is going to be what? 400,000. Okay, then we'll come to the grants. Okay, so the grant to deferred income is 200,000. Then amortization is going to be 200,000 of 5. So how much are we going to get? We are going to get 40,000. So what will be the balance of the grant? It will be 160,000. Alright, so these are the current amounts of the grants at the end. These are the current amounts of,
160.
yeah, at the end of the day. Okay, so in our balance sheet, what do we do? At the end of the year, first year, in our balance sheet, under our asset, non-current asset, we recognize the machine. The current amount of the machine is how much? 400,000. This is 31st December, the end of the year, maybe 2023. 100,000. When it comes to our equity, so this is asset, deferred income. How much is left? 160,000. Yeah, so that's it. So this is our balance sheet. Now let's go to our profit or loss. Profit or loss, we have to recognize depreciation. The depreciation of the assets. The asset, the depreciation is 100,000. Okay, this is an expense. Okay. Then we also have to recognize the amortization of the grant. How much is it? 40,000. Okay, that's it. So this is an income. So you have to know the difference. This is an expense. This is income. Yeah. So that's how we treat government grants when it comes to capital grants. You know, that's now the other method. Okay, the other method we don't. What we do is that we deduct the grant from the cost of the asset. Okay. So for instance, we're buying the cost of the asset is 500,000 and the government has given us a grant of 200,000. So here what we do is instead of recognizing the full cost of the asset, we only recognize 300,000 as the cost of the asset. We deduct the grant from the cost of the asset. Okay. So in that case, we are not going to recognize any deferred income. Um, we are not going to recognize any deferred income for the grants because we have already deducted it from the cost of the asset. Okay. So that is the other method. We deduct it from the cost. We deduct the grants from the cost of the asset. So this will become the new cost of the machine. Okay, and you start depreciating it. So when you depreciate this, okay, it will be 300,000 over 5, which will give you how much? Which will give you 60,000. So you note the difference. So under this approach, the depreciation is 60,000, but under the first approach, the depreciation is what is it? Depreciation is 100,000. See, yeah. So, but then at the end of the day, they are going to be the same. Okay, they are going to be the same at the end of the day because the other approach, even though the depreciation is 100,000, there's a grant of 40,000 income. So when you deduct 100,000 minus 40,000, you get 60,000. So the effect is the same, but it's just the presentation that is different. All right, any question? Okay, let's move on. There's no question. Okay, so that is the government grants. What else? Let's look at the next FRS 5. FRS 5 is about non-current assets held for sale and its continued operations. Current assets held for sale. So this standard comes in when a company has an asset that it is using. The company is using the asset, and at the point the company decides to sell the asset. Okay, so this standard gives us the principle we should follow when we will have an asset and we want to sell it. Do you get it? Okay, anyone to tell me about this asset? Sorry, this standard. Okay, anyone? What is the initial recognition of an asset held for sale? What is the principle for the initial recognition of an asset held for sale? Anyone to help? Okay, the initial recognition. Hello, are we there? Or there's a network problem. Do I have a network problem? Or you can hear me? Michael, do you hear me?
Oh, you are here.
Or there's a network problem? When it comes to online teaching classes, we usually hide behind network problems to dodge
You are here.
to, do- to dodge questions. Okay.
You are here.
All right. So, what do you remember about initial recognition of IFRS 5? Do you remember anything on this?
I'm trying to.
Remember? Okay. Yeah. So let's say that we have an asset. The cost of the asset is
Think the lower of, of their carrying amounts, that
mhm.
is the book value, and their fair value less cost to sell.
Okay. Yeah, that's correct. Is the lower of the carrying amount, the lower of the carrying amount,
And their fair value
and
less cost to sell.
the fair value less cost to sell. Okay, that is the initial recognition principle. Okay, on the date of the decision not to sell. All right, yeah. But before you can recognize an asset as held for sale, certain conditions must be met. Okay, who can mention one condition? Before you can recognize an asset as held for sale, uh, are we all writing the FR come Monday, this Monday?
Yeah, you are all right.
Okay then this should be at your fingertips because because. All right, so certain conditions must be met before you can recognize. So one of the conditions is that the management should have a plan. Okay, management should have a plan, or management should be committed to a plan to sell the assets. Okay, they have decided how they are going to sell the assets. They have put in adverts on the media. They are actively looking for a buyer. And also the price tag of the asset, or how much they are selling the asset for, should be reasonable. Okay, you know, you cannot wake up and say that you are selling your assets if you have not put in place any plan. Okay, so one key condition is that management should have a plan, a solid plan that we are going to sell the assets, and they are selling it at a reasonable price. Okay, and then they are actively looking for a buyer, someone to buy the asset, and they intend to sell the asset within a year. They not 2 years or 3 years. They want to sell it as soon as a buyer comes. They are ready to sell it. So when these conditions are met, then we can recognize the assets as held for sale. Okay. So let's say that we have um, an asset. We bought the asset on 1st January 2020. Okay, we bought it on this date. The cost of the asset is, let me say, 100,000. What is for 100,000? And the useful life is maybe 5 years. Okay, we intend to use it for 5 years. Okay, now we use it for some years. Okay, and then on 1st January 2023, the company said they want to sell the assets. They are no longer going to use it. They want to sell it. Okay, so it means this asset has to be classified as held for sale. All right. So on this date, the asset will move from non-current. Assets held for sale are classified under current assets, not under non-current assets. They are classified as under current assets because management intends to sell the assets any point in time. So it becomes a current asset. Do you get it? So when you classify when an asset is going to be sold, it is moved from non-current asset to current asset. Yeah, so we move it, but what value should we place on the asset? What should be the current amount of this asset we are going to sell? Okay. Which Michael said is the lower of the current amount and the fair value less cost to sell. So we on this date we need to know the current amount of the asset. So how do we determine the current amount? So the current amount is the cost minus the accumulated depreciation from the date of purchase all the way to this date. So how many years have we used the assets? We've used it for 2020, 2021, 2022. So we used it for 3 years, isn't it?
Yes.
We used it for the whole of 2020, the whole of 2021, and the whole of 2022. So it's 3 years. Is that not so? So the accumulated depreciation is going to be 100,000 over. Okay, the useful life is 5. Multiplied by 3 years. So how much are we going to get? That will be 30,000. Oh, isn't it? So we are going to get 70,000. So this is the current amount on the date of classification. Now the fair value. Okay, in the exams they will give you the fair value. So let's assume that the fair value is maybe 65,000. Alright. So now which of them are we going to pick? The current amount and the fair value. Which fair value less cost to sell. Okay. Fair value less cost to sell is 65,000. So which figures are we picking as the current amount of the non-current
The,
asset?
the accumulated depreciation is supposed to be 60,000.
It's supposed to be 60,000.
Yeah.
Okay. 60,000. Okay. So so this would be how much? 40,000. Okay. So then let's say that the fair value less cost to sell is now maybe 35,000. Mhm. Okay, so which of these figures are we going to pick? for our as the carrying amount of the non-current asset held for sale.
35,000.
So on this date, we are going to recognize the non-current assets at this amount. Okay, and then another thing, you have to check whether there's impairment. Okay, impairment, you have to check for impairment. Impairment is when the carrying amount is more than the recoverable amount. So if you look at here, the carrying amount is 40,000. But the fair value is how much? The fair value less cost to sell is how much? 35,000. So there's an impairment of what? 5,000. So
5,000.
so on this date, on the date of reclassification, we have to recognize impairment of what? 5,000. Do you get it? Yeah. So that is how IFRS 5 is about. Is it difficult? So the main work here is to determine the carrying amount. In exams, they will give you the purchase date and then the date of the classification or the date of the decision to sell. So you have to know, you have to use that information to calculate the accumulated depreciation and to get your carrying amount. Then you compare it to the fair value. Okay, then that will give you your, and then you pick the lower of the two, and then you'll be good to go. Any question? We good? Are we good? Okay, so what else? So we dealt with, okay, so is there any standard you want me to talk about? So we dealt with these three standards. Oh, you are okay.
Property, plant, and machine. PPE.
Okay, PPE. Okay. So PPE is not difficult.
So we should go on IAS 12, income tax.
Okay, let's do income tax. And then, as for PPE, there, I know everybody can do it. PPE, we are only, the main thing is to determine the composition of the cost of the assets. So it's the purchase price plus all direct costs, okay, associated with in acquiring the assets. Okay. And then you have to know depreciation, how to depreciate the assets. And then you also have to know about revaluation. Reval, you need to know about the different measurement models, like the cost model and the revaluation model. And you need to know about revaluation surplus, revaluation loss, and those things. I think those are the main issues. Okay, IS 12 is income tax. This standard talks about how we should treat income taxes. Now, when it comes to income tax, every country has let me say, a revenue authority. So in Ghana, we have GRA. They are in charge of tax administration. They determine how much tax an individual or a company has to pay, and they have their way of calculating the tax you have to pay. You see, And then when it comes to accounting also has a way we calculate our tax. Okay, so when it comes to income tax, okay, and financial reporting at level 2, okay, the main issue is how to calculate income tax expense. Okay, how to calculate income tax expense and how to calculate deferred tax liability, um, and then deferred tax assets. Okay, so under level 2, you need to know these three things. That's all. These are the things you need to know. How to calculate income tax expense for the year, deferred tax liability, and deferred tax assets. If you know how to, if you know about this, you are good to go. Okay. Now you have to remember that GRA, they have the final say when it comes to how much tax a company has to pay. So every tax amount that a company has recorded in its financial statement, it's a provision. You have to remember that it's a what? It's a provision. Okay. And we know what a provision is, right? That provision is under what? IAS 30, I forgot. IAS 37 or so. Who can remind me? Provision is what? Okay,
37.
it's IAS 37. Okay, yeah. Yeah, provisions. Yeah. So every tax accountant will calculate, it's a provision, because at the end of the day, GRA will determine how much tax the company has to pay. Okay. So usually the income tax we see in our, so when you take a financial statement, a typical financial statement, you see sales, cost of sales, profit before tax, and then you see profit before tax, and then you see tax. Profit after tax. This amount is a provision, and you get it. A provision means that it is, when it comes to provision, there's a degree of uncertainty as to the amount that we are going to be paid, and the timing when we are going to pay. Okay, so provision is, we know we have to pay tax, but we are not sure how much we have to pay. So it's a provision. GRA will determine. So sometimes we can make a higher provision than how much we pay, or other times we can make a lower provision than how much we have to pay. Do you get it? So that leads us to over provision and under provision. Okay, over provision, under provision. You get it? Now let's look at an example. Let's say in 2022, company, okay, made a tax provision of um, this is the profit or loss. Okay, let me do it nicely. So 2022, profit before tax. We put it here. And tax. The company made a provision of tax of maybe 15,000. Okay, and that's 25% of the profits before tax. Okay, so they are going. This will be in a profit or loss. Okay, when we come to the balance sheet, it will show, okay, in under liabilities. So we come to the balance sheet, and the balance sheet under our current liabilities. A provision is a liability. So we record tax provision. Okay, so whatever is here, this amount, we will come and record it here. That's 2022. Okay, the year 2022. And usually tax is paid the following year. Okay, so 2022 tax will be paid in 2023. So GRA has come to come and determine how much tax we have to pay. And they said we have to pay 30,000. Instead of the 15,000, we have to pay 30,000. And so we have paid. Okay, so when we pay, what will be the double entry? When we pay, we are going to credit our bank because we are using money to pay. GRA said we should pay 30,000, so we debit our bank 30,000. We credit our bank 30,000, then we debit our tax provision. You see, remember we only provided 15,000, so we cannot go beyond 15,000. So now the issue is what will happen to the rest of the amount. Because it has to balance. This side and this side has to balance. This side will come to what? Income tax expense. It will go to the income tax expense for the year. So we'll record it here. So that this will be 30,000. And this side will also be 30,000. Do you get it? So what I'm trying to illustrate is that when there's over provision, okay, that over provision. So when there's under provision, in the case of this, okay, the under provision is treated as income tax expense for that year, or for the following year. Do you get it? And when there's over provision, it is treated as let me say an income. Do you get it? Expense, under provision is an expense. Over provision is an income. Okay, so when you are determining the income tax expense here, okay, you need some key figures. One, you have to look for whether there's under or over provision. Okay, so if it's under provision, it will be an expense. Okay, if it's over provision, it will be income. Okay, if it's under provision, it's an expense. If it's over provision, it's an income. Then the next thing is you have to look for the provision for the year, the tax provision for the year. In the question, it will be given to you. So you add it here. This one is an expense. Then the last thing is you have to check for any increase or decrease in deferred tax, or the movement in deferred tax. It will come here. If there's an increase in deferred tax or decrease in deferred tax, it will come here. Then you have your tax expense for the year. Then you put it here. Do you get it? Okay. Now let's look at deferred tax liability. Deferred tax liability is when occurs when the carrying amount of an asset is more than the tax base. The carrying amount of an asset is more than the tax base. You get it? It leads to deferred tax liability. And what does it mean? It means that GRA will say the GRA would say pay 3,000 cedis. Okay, but accounting, when you did your accounting calculation, okay, you are only paying, you are paying maybe 6,000. You get it? This is accounting tax, GRA tax. When you did your accounting calculation, you're supposed to pay 6,000. GRA says you should pay only 3,000. You get it? It means that you are paying half of this amount, so that remaining half is deferred or is going to be paid in the future. So that's what we call deferred tax liability. And it's because of the way GRA calculates tax and how accounting calculates tax. They get it. So GRA says pay 3,000 cedis, and you have calculated determine your tax to be 6,000. So you are paying 3,000. There's a 3,000 waiting for you to be paid. Okay. Then we also have deferred tax assets. Okay. So this is when the carrying amount is less than the tax base. Okay. And here the illustration is that GRA says pay 3,000. Okay. GRA says 3,000. And you accounting, when you did your calculation, you are supposed to pay maybe 1,500. So what it means is that when you did your accounting tax calculation, you are supposed to pay 1,500, but GRA is telling you to pay more than that. So it's like now you are paying in advance. You are it's like you have a credit. Let me put it that way. You determine that you have to pay 1,500. GRA say pay 3,000. So you are paying double of what you initially provided for. So it means you have pay tax in advance. You have an advance credit. So that is why it is called deferred tax asset. Deferred tax asset. That's basically what this means. So deferred tax liability is when the carrying amount of an asset is more than the tax base. And when this happens, it means that the accounting tax is going to be more than the GRA tax. You get it? And when it comes to deferred tax assets, the accounting tax is less than the GRA tax. That leads to deferred tax assets. Okay, so that's how. So in exams, you usually come across a note, especially for published accounts. They will say that the carrying amount of the company asset is maybe 30,000 more than the tax base. So when you read that phrase, then you should know that they are talking about deferred tax liability. So they will say the carrying amount of the asset is maybe 30,000 more than the tax base. So when you see more here, you should know that they are talking about deferred tax liability. And usually they will give you the tax rate. Maybe they will say the tax rate is 25%. So if you want to know the deferred tax liability, it is the increase or the difference 30,000 multiplied by the tax rate 25%. That will give you the deferred tax liability. Do you get it? I'll give you the deferred tax liability. Okay, is there any question? Alright, so we are going to end here. And I think, yeah, there's just a day just to go through some key accounting standards. Alright, so I wish you all the best. And go and practice it. You know, our standards are not difficult, so try and practice and focus on them, and I believe you do well. Alright, so see you next time.